It's never too early to get ready for perhaps the most important earnings of the season. That is, of course, Nvidia. Joining us, Angelo. Zino is the man to prep us on the numbers. Tom White's going to do some trading in the options. Angelo's VP and Senior Equity Analyst at CFRA. Angelo, thanks for being here this morning. What's the most important thing for Nvidia today?
Yeah, no, thanks for having me, Oliver. So for us, it's clearly going to be the trajectory of Blackwell, and really kind of everything hinges on that right now. As far as the results are concerned, I mean, we do expect them to have a notable beat. Street's looking for about 8 to 9% sequential growth. Again, it's a number that they should be able to beat as far as the guide is concerned. Looking for about revenue of 42 billion or so. It'll be interesting to kind of see whether or not they're conservative or not in terms of that guide, because of the Blackwell delays that we've seen kind of specifically on the rack systems. You're going to see some Blackwell revenue tied to this quarter. We do think Blackwell kind of exceeds Hopper in the April quarter, but it's all about the trajectory specifically on those larger scale rackable systems, because that is supposed to kind of create this kind of next leg up in terms of kind of the Nvidia revenue trajectory. In fact, the Street's looking at 10% sequential growth in each of the following 3 quarters, starting in the April quarter. So there's some kind of built-in expectations that Nvidia is going to get this right in terms of Blackwell, and we're going to see some nice revenue there.
Okay. And the Blackwell is the area of least certainty, most potential for surprise then, given some of those delays, Angelo? Because when I think about what moves the stock, it's whatever has the most potential to surprise.
Yeah, I mean, as far as this quarter is concerned, the guidance is concerned, that's what I would say is kind of the shift towards these rackable systems and how these configurations look like, right? Are they putting more NVIDIA-based type of CPUs in there in terms of the Gray CPU relative to the x86 architecture? Are we putting more of those kind of NVIDIA networking chips in there as well? So these rackable systems and kind of the trajectory of revenue tied to that is going to be really kind of interesting to watch going into the April quarter. So that on the guidance side of things, I'd say that. Oh, and then you've also kind of got the China uncertainty out there, right? I mean, there's definitely concerns about there on the geopolitical front. I'd expect to see some sort of pull-in effect in terms of some of that China revenue. I think the Street probably looks past that because of the uncertainty that you're going to have come April, May in terms of the determination of how kind of, of where Nvidia kind of sits as far as the geopolitical issues are concerned. But those are going to be the biggest needle drivers, at least as far as the April quarter is concerned.
How about the role of competition from DeepSeek? The early narrative on that was that the lower priced, higher efficiency was going to reduce the need for demand, but it seems like there is an equal, if not better, argument to be made that just demand overall for large language learning models of all forms are going to require big power sources like NVIDIA's Blackwell. So is it possible we could see like a pickup from Asian or Chinese clients? How do you view that relationship right now, Angelo?
Yeah, I mean, listen, as far as kind of the Asian suppliers, I mean, we've actually gotten more bullish on China here in recent weeks. I mean, we're believers actually of kind of the trajectory and the acceleration and growth that you're going to see in a name like Alibaba out there. In fact, I mean, you kind of look at some of the CapEx numbers that they've thrown out here over the next couple of years, and it's going to be very aggressive on their end of things. So kind of assuming that they can get their hands on these NVIDIA chips, expect that to kind of be a boon for NVIDIA out there. As far as kind of the DeepSeek situation is concerned, or post-DeepSeek environment, I think it's kind of this mixed picture out there. I think long-term, the trajectory is very positive. I think it's going to result in greater adoption of AI. It's going to result in significantly more need for compute and capacity out there. And of course, you're going to invest in accelerated workloads and not unaccelerated workloads. So that's going to be a boon for NVIDIA. I'd say kind of more near-term, more kind of the murky picture as far as these large language models are concerned post-DeepSeek. It is going to commoditize a lot of these models, and that's going to kind of cause prices to come down, and that's going to create a more difficult scenario for companies like Microsoft to monetize these models, at least kind of in the near term. So longer term, we like it. Near term in nature, it could be a little bit murky.
Okay. And all of it, as it pertains to valuation, how does it add up, Angelo? How much breathing room does NVIDIA have if we normalize the valuation to growth, which is what I think we have to do here, take some kind of PEG ratio?
Yeah. No, so on a PE basis, obviously it looks attractive. It's only 25 times our estimate for 2026. If you're assuming kind of a long-term earnings trajectory of at least 15 to 20%, which we think is still very feasible out there, and it is significantly lower than what we've seen here over the last couple of years. This is a company where, on a PEG ratio is trading kind of at the lower half of its historical range. So there is move or the potential for kind of some sort of multiple expansion over time here, but you kind of need to get some of those uncertainties that you got to get past some of those uncertainties specifically related to some of those Blackwell delays, and as well as kind of the uncertainties tied to, some of the geopolitical concerns that are out there.
Great stuff. Thank you very much, Mr. Zino.
Yep, thanks for having me.
Excellent prep. Tom, with Angelo's target of 165, it seems like for 12 months, our question is, how bullish do we get? So you got two different trades. Take us through.
Yep, they're both bullish. One's a little bit more conservative, trying to take advantage of the higher implied volatility levels. Okay. So I looked at going out to the March 7th weekly cycle. So it's not a pure earnings play, giving myself a little bit of time if the stock does trade down. March 7th weekly options, 9 days to expiration on this one, taking advantage of the high IV going into this report. Option market pricing in about a plus or minus 9 to 10% move, about $12 either way in the share. So going out to that March 7th cycle, selling the 125 put, and then buying the 115 put, so a short $10 wide neutral to bullish put vertical. You can collect roughly I got about a $3 credit on it earlier. It's probably trading closer to $2.50 right now. But if you collect that $3 credit, that's what you can make. You can see here from the risk profile. It takes my break even down to 122 over the next week and a half. That's about 5.5%, 6% below the current share price. So still within that one standard deviation move that the option market's pricing in, but you profit in 3 out of 4 scenarios on this one. Stock goes higher, stays where it is, goes lower, but remains above 122. You can be profitable on this one, this short put vertical.
All right. So that's one way that is more about betting that it doesn't break down.
Right.
Give me the one that bets on it breaking out.
Breaking out. Yeah, and I mentioned that one standard deviation move, about $12 in the shares. This takes advantage of that and dispersion between implied volatility levels. I think that's the key with this one. If you think it's going to go up, that one standard deviation or more, this type of strategy takes advantage of it relatively quickly. I looked at a call diagonal, went out to the March 21st monthly cycle, so 23 days to expiration on your long option by the 130 strike call. And then in the near term, February 28th, weekly options that expire in just 2 days, sell the 142 strike call. So a bullish $12 wide call diagonal to the upside on this one. You're paying roughly about a 7.5 debit, maybe a little bit richer than that, maybe closer to $8 now with the stock moving higher. But if you pay 7.5 debit, there's your risk on a $12 wide call diagonal. So you're paying less than the width of the strikes on this one. And the vol dispersion is why the price of this and the risk on it is lower, because you're buying about a 75% implied volatility level in the March 21st options on aggregate, where you're buying the 130 call, selling about 160% implied volatility in the February 28th 142 strike call that you sold. So that dispersion lowers the entry point and risk on this trade. Anything above about 133 is going to be profitability on this, and you'll have 3 opportunities to roll or adjust that short 142 strike call as you get closer to expiration. It's positive time decay, so this is a little bit more aggressive. You can increase potential profitability on those rolls or adjustments also.
Okay. Like it. 2 approaches to get bulled up in a name that I think a lot of folks are ready to get bulled up in.
Yep.
And they're doing it already with 3.5% rally this morning. NASDAQ futures now up 0.7%. Thanks, Tom, for the trades there, getting us ready for the report. Thanks, Angelo, Zino, for the numbers.